Welcome back to Ask the Compound. I'm your host, Ben Carlson. The S&P 500 hit new all-time highs in February. Then it fell nearly 20% in the Liberation Day tariff stuff. Now we're right back at all-time highs. Let's say you sold some real estate recently, and you have a big slug of cash that you want to invest. Should you be scared of investing at all-time highs? I will answer that question and more on the show today. Stick around. Our email here is askthecompoundshow@gmail.com. I'm always happy to answer your questions live on YouTube or Twitter live streams as well. On today's show, we answer questions straight from our compound viewers about, was that a healthy correction in April? Did we actually need it? Was it necessary? How much should you be willing to spend on your dating budget? As a middle-aged guy, I don't know if I'm really okay to answer that one, but I'm going to try.
You're really excited about that question.
That's pretty good. Are young people screwed with the high cost of education, healthcare, and housing? Does it make sense to have a balanced portfolio if you are a younger investor? And finally, should you be nervous about investing your money at new all-time highs? All right, today's show is brought to you by Exhibit A. Exhibit A is a platform that we built specifically for financial advisors with custom-branded, data-driven visuals that advisors can use to communicate with their clients and prospects. Exhibit A gives you access to hundreds of daily updated charts, 10-plus deck templates, fully white-labeled with your logo, your colors, your headshot, and your disclosures. Plus, you get talking points each week. And each week, we're also on Fridays sending out a chart of the week with relevant talking points to your clients to understand what's going on in the markets and the economy. It's really cool. In seconds, you can create polished market and economic updates, complete with expert commentary and then automated delivery. So basically, you're spending less time prepping decks and more time building trust with your clients. So check out exhibitaforadvice.com. If you're an advisor, sign up for your free 7-day trial. It's great. People love it. We're going to use some Exhibit A charts on the show today, too.
It's true.
Let's do it.
Also, I see in the chat already, Seth, we've got some overlap with Animal Spirits. Seth saying that he couldn't believe, the stat about people tipping on Uber. How you said only 20% of people.
20% of people tip on Uber. I was shocked by that, too.
I was telling you, though, I understand it because Uber's whole thing in the beginning was you don't have to tip, you don't have to carry cash, we pay a good wage and all this kind of stuff. And now after they have the entire market, they're like, actually, you should tip. And
I imagine a lot of it probably is people who use it more in bigger cities, which I don't live in. So I don't use it nearly as much, so I tip when I do it. But I'm sure if you use it constantly, you're probably not always going to tip as much.
Yeah, and in my experience, a lot of the trips are not very good, so you don't have to worry so much about it on those, But I've almost gotten into a wreck in 2 of my last 3 Ubers that I took. So
there should be more. I feel like there should be more accidents in New York with how people drive there. But you don't like the free chargers and free water and free lifesavers? That's perfect.
It's true. If you got that, then yeah, that's a tip. That's automatic tip.
All right, let's do one.
Okay, up first today, we got a question from Jeff. My question is about the pullback earlier in the year. While no one loves seeing red, I personally feel more comfortable and almost relieved that the tariff tantrum correction happened rather than seeing a third straight year of 20% gains without pause. That kind of run starts to feel euphoric, maybe even bubble-ish or stonk-ish. Do you agree? Does this pullback make you feel better about the health of the market moving forward?
Okay, and Dave in the chat asks where I'm beaming in from today because I'm at a different setup. I'm in God's country in northern Michigan, heading out on the lake right after this show. Okay?
Nice.
Beautiful. So Jeff is essentially asking, was April a healthy correction? I've looked for this before, like where the term healthy correction came from, and no one really could give me an answer. I think a healthy correction can be a good thing if it helps stave off an unhealthy correction down the line. So I actually kind of agree with this premise. Like the stock market cannot go up 20% year in and year out, right? 2024 was a 26% gain for the U.S. stock market. 2025 was 25%. And you don't get those big gains without the occasional big loss. It just has to be this way. If investing in the stock market were easy, everyone would just have all their money in stocks, and then you wouldn't have the risk premium. So I think you need some of that. I do think the whole Liberation Day tariff trade war kerfuffle does seem unnecessary now that we had to go through that. But regardless of the reasons, I do think a slap on the wrist here or there is a good reminder for investors that risk exists. And I have all sorts of data on historical corrections. So Daniel, I want to do a chart on. I got this one, this table. It's every historical correction on the S&P 500 going back to 1928. By my count, there have been 34. Now, I count healthy corrections as you're down 10% to 20%, right? 20% is that bear market. Where did we come up with that definition from? I don't know. Someone just made it up. So the average decline of these 34 healthy corrections, again, losses of 10% to negative 20%. It's an average decline of 14%, lasting 114 days, peak to trough on average. A bear market itself, the average is a loss of more than 30%, and that could take like a year from peak to trough. So my feeling is every correction is healthy with the benefit of hindsight as long as you have a long enough time horizon and you don't panic in the moment. So sure, I'm on board. April, while unnecessary from a policy perspective, was probably better than the alternative of the stock market just off to the races to start the year. Although we're back up to, I don't know, up 5 or 6% this year, so it's not terrible halfway through the year. And although maybe that healthy correction doesn't matter if we get an AI bubble anyway, but yeah, so that's a healthy correction. I'm on board. I think that was probably necessary given what we had the last 2 years.
So I keep hearing you say if we get an AI bubble, it already kind of feels like one has begun. You're saying this is nothing compared to what it could become?
Yeah, I think a true bubble, you're going to see some crazy. Now, the hard thing is, I'd mentioned this before, like no one ever knows when we're actually in a bubble. People can always tell when we're in a crisis, but no one knows when we're technically in a bubble. So it's hard to say. But I think, can this get much, much stupider? Oh, yes, it can. I think that we haven't even touched the surface of how stupid things could get, potentially.
You say stupid, I say exciting. So,
Yeah, same
let's
thing.
see it.
All right, let's do another one.
Okay, up next.
My favorite question of the year so far.
Yeah,
right here,
yeah.
next one.
When this one came in, we were all laughing. So yeah, this is a good one. How should one balance dating or socializing when it could impact your monthly dollar cost averaging by 25%? And that's their rough monthly estimate.
So we had a fun little debate internally when this one came in, and we said, "Wait a minute, is this real? Is this serious, or is this tongue in cheek?" And the thing is, we have so many spreadsheet warriors who follow our content, and I think young people have kind of weird views on dating these days that I'm going to assume this one is real. All right, for the
And don't tell us if it's not. We want to believe this is real.
I am so thankful that I grew up in the outside of the online dating social media era. I did not have to do that. So I prefer the old days where you had to get turned down in person at a party or the bar, not just swiped or someone went right past you. So obviously the idea of dating can be expensive, makes sense, and potentially eating into 25% of your dollar cost averaging. I'm sure this person is doing the math in his head and going, wait a minute, if I stop saving, it's going to be this much in the future. Obviously, this is a good lesson in priorities, I think, when it comes to saving and spending. How important is your social life? As a younger person, it should be very important. So listen, when I was in my early 20s, after my first job, and I didn't make a lot of money, my social entertainment budget was by far my biggest discretionary spending category, right? I loved going out. All the time, I had to go out. Now I'm a homebody, but I feel like I got it out of my system, right? That's when you want to do it, though, when you're younger, not when you're older and you have more responsibilities. Obviously, no one can tell you what you should prioritize spending-wise, but I think you do this stuff in your 20s. And listen, I love hearing young people who are thinking about saving money because compounding can have a huge impact on your ending balance. But there's all these fire Reddit posts, and you see them posted all the time, where people talk about how miserable they were because they prioritize saving and being frugal over their family and friends and relationships. And listen, relationships are it. Every single research report shows that the true thing that builds happiness over time is the relationships you have. So go out in your 20s when you have your time and energy, right? And you have a few drinks and it doesn't give you a 3-day hangover or something. Like, I don't want to go out all the time now that I'm in my mid-40s. I'm happy I did in my 20s because that's when, like, you can do it, right? Could you find some other areas to cut back? Brown bag to lunch, cut a streaming service or two, but don't make the dating and relationship thing your one. Also, maybe you could find creative ways to, on your dates, you're not spending on expensive dinner, drinks, and shows. We were talking to some of the younger people who work at Ritholtz. We have this younger cohort, and they were saying, listen, I took someone out for dinner and drinks and a show, and it cost me $400 or something, right? So listen, as a guy who's been out of the game for 20 plus years now, maybe this stuff is passing me by, but I don't know. Take someone on hikes, picnics in the park, game nights, going to the beach, right? These things don't cost money.
A 6-pack in Maguanas Canal.
Right? Exactly. Yes. I mean, it honestly costs about a 6-pack for a single beer when you go out in New York, right? And also, if you do go on some dates, do not tell them that it's eating into your monthly savings. That does not go over very well, I'm sure. But do feel free to give them your credit score, because I'm sure you have a really good one if you're worried about this. That's the sign of a good mate, right? An iPhone and a credit score. They know that you're going to be a good provider for the family.
I mean, all kidding aside, they probably should make sure that they are compatible financially with the person that they're dating. Because if they're with someone who has no idea anything about saving or finance and is just spending all the time, and it's only going to set them up for a lot of problems, probably.
Probably. The funny thing is, though, usually it is the thing of opposites attract, right? We had
It's
Scott
true.
Rick. We had Scott Rick on the Unlock last week, and he's wrote a book called Tightwads and Spendthrifts, all about the different mentalities when it comes to saving and spending. And he says usually that's what happens is you get these people, and sometimes I think the opposites attract thing can actually help because one person can loosen up the purse strings on the tightwad, and then the tightwad can kind of rein in the spendthrift a little bit. So sometimes maybe not too bad. But
So wait, are you a combined or a separate accounts, a joint account or separate?
oh no, we're
person?
definitely joint accounts. Maybe if someone wants to ask that question sometime, I think we've covered it. But
We have, yeah. Okay.
I don't think the separate. I think that's tough, the separate account thing. So yeah, but don't forego dating because of compounding, please.
Right,
Please.
and Jay Luther in the chat says, "Date a rich girl. That's the only way I get to play at the country club." So
Yes,
always that.
yes, that's the best compound interest you can have. Is just marry wealthy. All right, let's do another one.
All right, up next we got. I live in Miami, and my friend's daughter is looking at colleges. Tuition at University of Miami is $80,000 a year. So with loans, she could graduate $320,000 in debt. Add grad school, and it's easily over $500,000 by age 25. It's hard to see how someone with that kind of debt finds a $100,000 plus job right away. In an economy that's 70% consumer driven, what happens when the next generation is too buried in debt to spend? Is there a tipping point? I'm also house hunting, but prices are sky high. If I'm counting on the next generation to buy my house, but they're crushed by student loans and can't get a mortgage, what happens to real estate? I know the greatest wealth transfer in history is coming, but is that really enough to fill the gap? What are your thoughts?
All right, Duncan, I know this is something that's near and dear to your heart. You've been talking to me about this for a while. And when you look at these numbers that Craig provided here, it does seem to go, okay, this doesn't make sense. No one can ever survive this. I do feel young people face a lot of financial challenges that previous generations did not have. Student loans, the high cost of housing, healthcare, higher transportation costs. We just lived through the highest inflation rate in 40 years. I certainly sympathize with young people, especially on the housing front. It's just bad luck if you missed out on like a generationally low rates and a generational bull market. Like it's nothing that you did. This is again the Robin Williams. It's not your fault. No, it's not your fault, right? Having said that, things aren't nearly as bad as Craig lays out here. All right, allow me to interject with some data. First up, Daniel Chardon. This is from The Economist. Adjusted for inflation, Gen Z makes more money than any generation that came before them. And they make 50% more than baby boomers at the same age. So this is at the same age, again, inflation adjusted. This is kind of shocking. Now, the thing you said to me, Duncan, the other day was, okay, I know a lot of young people who are making more money than ever. Like, how come it's not working out, right? I think it helps that this generation is the most highly educated ever, right? Every generation going forward is probably going to be more highly educated. That means higher starting wages. But then what about student loans to get there, right? Well, there are people who have six-figure student loan balances. It's not really as prevalent as you think. So Daniel, let's do a chart on here. This is the distribution of student loan borrowers by balance from the Federal Reserve Bank of New York. The average number is all over the place. So I found like 30 to 40K on average from different sources. But this data shows that 58% of borrowers have 25K or less in student loans, 78% have 50K or less, and just 8% have 100K or more. So the idea that everyone is taking out six figures in debt is not true. Most of them are probably people who are, going to grad school, going to law school, going to med school, and then some people who unfortunately do a humanities degree and get their master's that, is worthless.
Or now a computer science degree.
Right. And the funny thing is, when I graduated college in 2004, way back when, my student loan balance was $25,000. So I inflation adjusted that. That gets you to like 42, 43. That's probably pretty close to a little bit above average. But the thing is, my rate at the time was we could refinance at like 2%, which doesn't make any sense because the 10-year yield was about the same now as it was back then. For some reason, student loan rates were just lower. So this is my one diatribe is why does the government need to make so much money on these loans? Why wouldn't they just make you pay back the principal or charge you a much lower rate of interest? That's my soapbox thing here. I don't know why the government has to make 6, 7, 8% on student loans. I would look at this as an investment in the future. And remember when they were talking about should we cancel student loan debt? My idea at the time, I think I wrote a blog post about this, was why don't we start canceling the interest? Cancel the interest, make people pay back what they took.
If you ask most people that have good jobs and have student loan debt, they're not like, oh, I think that it's fair for my loans to be completely forgiven.
Right.
The thing I hear the most is, yeah, can we just maybe like get the, just pay the principal or get a, break on the interest? The interest compounding, as everyone watching the compound knows, compounding against you over decades is insane.
Yes.
7% over, 15,
That's
20
a lot.
years.
Yeah.
It's
It,
crazy. Yeah.
that's the big problem, I think. So the question is, Craig looks at the sticker price for the University of Miami. I wonder if it's really that much because Josh's daughter goes there, and so we got to ask him what he's paying. The thing about these numbers is that basically no one pays the sticker price. So Ron Lieber wrote this great book called "The Price You Pay for College" that looks at college expenses, and I know there has to be a reason for this. I don't really know what it is, but basically no one pays these actual sticker prices. So the average first year full-time student, and this was in 2020, so it might be a little higher, but actually the inflation in these numbers has gone down considerably in recent years. They got a discount of 53% off of list price. The average grant for public universities was like $4,100 a year. 89% of all students at private colleges receive some sort of need-based or merit-based tuition discount. So the people who pay full freight are typically international students and very rich people. That's it. Or if you attend like a more selective school, that's harder to get into. So Lieber says, on average, what families are actually spending hasn't gone up by completely unreasonable amounts over the past 20 years, even as the list prices have gone to the moon. That's because the discount rate has gone up steadily over time as well. So he says the average price for a private college is $24,000. The average price for in-state public universities is $15,000. Now, obviously, that's way more than like the $250 a semester my dad was paying back in the day. He told me that's what he paid for classes, $250 a semester. That is seemingly ridiculous, but so these numbers are high, not nearly as bad as people make them out to be or think they are. And I don't know, I think it's just a prestige thing. Like, look, our sticker price is $60K a year, but you're only going to pay 30. It almost, I don't know, it's like JCPenney, where everything's just always on sale, right? Or J. Crew. Do I buy J. Crew still? Yeah. Do I only buy stuff on sale? You're darn right. 60% off all the time, right? I'm not paying full sticker price, just like college. So
You're not a fool.
I will be pushing for my kids to go to in-state public universities. Hopefully they will do that, right?
Yeah.
Okay.
The other part of this that I feel like isn't talked about enough is people are always making this like a class warfare thing where, people are like, oh, if it's people who went to college versus people who didn't go to college. And to me, the real enemy here is the universities that have just continued to jack up their prices over the year to absurd levels. That's the problem that is probably going to end up with regulation at some point, right? Because as someone who used to, teach at multiple universities as an adjunct, adjuncts are now making up almost half the teaching force at a lot of these big universities, including the really, prestigious ones. And adjuncts, last I checked, were making around $4,000 to $5,000 a semester per class. So it's not because the professor is making too much money. I would like to see a breakdown of where all that load is going.
The thing that's going to help there is demographics, because you can see the demographic cliff coming of 18-year-olds by year is steadily going down. So these colleges are going to have to compete for people. So I think that's going to help a lot of it. So obviously the thing is, even though these balances don't seem like much, listen, when you're getting your first job and you're owed 30 or 40K and you're paying 6 or 7 or 8% interest, that's still a lot of money for a monthly payment that eats into a lot of your starting salary. So even though it's not as bad as people make it out to be, it's still not great. What about housing? If you take the median housing prices and the current mortgage rates, the average monthly payment is at an all-time high, right? Of course, it has to be. So it is kind of hard to believe any young people can afford a house these days. The crazy thing is, though, it's actually still happening. So Daniel do a chart on this. Is from Redfin. They look at the demographics and do you own a home ownership rate by demographics at the same age, right? And they look at baby boomers, they owned much earlier. Gen X is pretty close. Millennial and Gen Z are a little far behind. And I think some of this actually makes sense because they go to school longer and they wait a lot longer to settle down. Baby boomers were getting married at like 22 years old, right? That's not happening for young people these days. So Gen Z is slightly ahead of the curve on income, but they're behind when it comes to home ownership at the same age as boomers, Gen X, and millennials. And it really wouldn't shock me if it stagnates for a few years now. If this line kind of flattens out and it takes some time for incomes to catch up. And I think that's kind of probably what will happen, is that it'll just take, and that's why we're seeing like a buyer strike, right? Where people are just going to wait for incomes to catch up, make that monthly payment make more sense, maybe wait for a slowdown in the economy where that slows mortgage rates. And I guess where I land on this is that young people have their challenges. Unfortunately, every generation has had their challenges in their formative years. Like baby boomers had the sky high inflation. I love to give baby boomers crap, but they had sky high inflation. They had 15% mortgage rates. Gen X had the bursting of the dot-com bubble leading into 9/11 and a lost decade for stocks. Millennials, I came into the labor market in one of the worst, job markets that there ever was following the great financial crisis. Gen Z is dealing with high costs and inflation for housing. But I'm a glasses half full guy, as you know, Duncan. So I think young people are going to figure it out. That's kind of just like previous generations did. That's kind of where I land on this. A lot of this stuff is not fair, especially, again, housing, I think, is the big one. There's a lot of stuff that seems unfair. I think housing is probably the biggest one. If you're stuck and your rent keeps rising and you can't buy a house, that's not great. But I have faith that this generation is going to figure it out.
I think we're going to see a lot of young people going into trades, using their hands more, doing stuff like plumbing and electrical work. I think you're already seeing that, a shift away from wanting to even go to a 4-year school and take on all this debt to begin with. Not that it's free to get trade school, training.
Yeah, but cheaper, and that's a good AI hedge too, right?
Yeah, and a private equity firm can buy you.
Yeah, there you go. All right, let's do another one.
Okay, up next we got, is a balanced portfolio advisable to younger people in their 30s or 40s, or is a balanced portfolio approach only advisable after creating sufficient corpus?
Yeah, I feel like this question had to come from an international viewer because you don't hear the word corpus very much.
Okay, yeah.
Right?
Yeah.
Not even sure I know what it means. I love that we're getting a lot of questions from young people today. We're covering dating, we're covering student loans, we're covering balanced portfolios. The way I see it is that it's basically impossible for young people to invest too aggressively because human capital is your biggest asset, right? Your future savings, your future earnings, that is the thing that matters the most. However, just because you have the ability to accept some risk doesn't mean you have the willingness to invest more aggressively. I always say that investing is not a one size fits all endeavor. Like you have to take your personality, your emotional makeup, your experiences into account, how you've dealt with losses and gains in the past. So I don't think it's as easy as inputting a bunch of numbers into a model and then having it spit out the perfect portfolio for you. Portfolio management is both an art and a science that involves trade-offs, that also involves knowing yourself as a person and an investor. And so the time horizon matters a lot when building your portfolio, but I think you also need to find a portfolio you're comfortable holding through thick and thin. And if you need a more balanced portfolio in your 30s and 40s, which requires, higher cash balances, higher fixed income, I have no problem with that as long as you understand the trade-offs you're making by not investing more aggressively in terms of expected returns and compounding. Fair? Duncan, do you count yourself as a balanced portfolio with triple levered NASDAQ 100 in Oatly?
I'm not a good person to go to. I'm not very balanced. My 401k is 100% stocks, I think. Yeah. I'd have to double check.
Me too. All right. And Craig, who asked the last questions in the chat. Great question though, Craig.
Yeah, thank you. Also, Dave just made me think too that we should mention, as this big beautiful bill stuff is going on, it is going to have a big impact on student loans. So you should check. You should log into your provider and make sure you have things in order if you have student loans right now. I saw they're extending that average forgiveness from 20 to 25 years up to 30 years, some stuff like that. So I would check on all that.
Good looking out. Dave in the chat says corpus is the capital or principal amount of an estate or trust. So that had to be someone from England asking this question.
Yeah, it feels very British. I picture Hugh Grant saying that.
All right. Yeah, there you go. With a floppy hair. One more question.
Okay. Up next, we got one that came in on YouTube comment, I think. I recently sold my condo for $400,000 and would like to invest the proceeds in the stock market. But with the market at an all-time high, should I wait for a correction or consider investing elsewhere in the meantime? All
right. Interesting. Someone kind of timed the housing market and said, I'm taking money off the table. So I don't know if it's a rental or what, or they're just moving into being a rental. I've gotten questions about all-time highs since we started hitting them again in 2013, and I started writing my blog. We got a ton of good charts here from Exhibit A, so why don't we go through them? All right. First one, all-time highs tend to cluster. So this is number of new all-time highs for the S&P 500 by year going back to 1990. And you can see there could be times where you go through a very big dry spell. Now, this was the lost decade, so you had a handful of new all-time highs in 2007 after having none from 2001 to 2006, and then you didn't have another one until 2013. And now you've had a ton of them, and you had 2023 none, a bunch last year, and then a handful this year. So these things do tend to cluster. So just because you've had one doesn't mean that they're going to all go away completely. But the hard part about this whole discussion is the fact that one of these new all-time highs is going to be like the one, right? Where you fall off a cliff. We just don't know what it's going to be. Let's do the next chart. This is a different way to look at this. So you can see all the dots on the chart there. This is just a prettier visualization that just shows like how much these cluster, but also like how many there are when you hit a bull market. Like there's a ton of them. So if you think like, okay, this is the one, good luck guessing which one it really is. And finally, this is one of my favorite ones. It's just investing at all-time highs is actually better for average returns than investing on all of the days. So this is looking out 1, 3, and 5 years from the day you invest. If you invest at S&P 500 all-time highs, it's actually higher returns going out 1, 3, and 5 years, which is very counterintuitive if you've never seen this data before. It's like, wait a minute, that makes no sense. Wouldn't it make more sense if you invested from lower value? But this is a momentum sort of bull market thing. And I think one of the things we've learned for the past 7, 10, 12, 15 years, no one can predict when this stuff is going to come to an end. Right? It's really difficult, and I think trying to time this stuff. Now listen, if you say, well, great, I would really regret it if I put this whole 400K into the stock market and fell out of bed tomorrow, and we had even a 10% correction. That's 40 grand down the tubes. Right? Sure, I can wait, but I don't want to. If it's going to make you feel better, then slowly but surely dollar cost average in, or make it a more balanced portfolio like we talked about in the last question, and have some sort of hedge there, right? So I think that I do think when you have a big lump sum pile of cash like that, you know that the numbers say just put it into the market. 3 out of every 4 years, the stock market goes up. That's really good probabilities, right? You're not going to get anything like that close to at a casino or DraftKings or something, right? It's not gambling like that, but the regret if you're wrong is probably greater. So if you want to just leg back into the market and dollar cost average in over a certain period of time, pick a period of time, pick a cadence, just put it in, set it, forget it. We go down 20%, you want to add a little more? Sure. But just because the market's at all-time highs does not mean that you should be scared or nervous. It's actually historically a relatively good thing for the stock market.
Yeah, I don't know if it's just me. I have a feeling it's not based on the questions we get, but it feels so much better to invest in something and see your cost basis average go down as opposed to up.
Yeah, it makes more sense,
but
right?
all the data says that, yeah, that it's actually better if it's going up. But yeah, it just feels good when you see like, oh, cool, I lowered my cost basis, so when it goes up, but yeah, I guess it's just not how it works.
You're talking yourself into Oatly again here. Is that it? Like, look at
I'm pretty good on Oatly for now. If I'm happy with my position.
All right. And since we're all about transparency here at Ask the Compound, I think like a month ago, someone asked a question about a HELOC and doing a renovation. We get a lot of renovation questions. Remember the guy in the chat a few weeks ago asked about putting a pool in for 100 grand or whatever?
Right.
And I mentioned that we were going to do some work on our house. My wife wants all new flooring because the carpet's going bad, and like either we do the carpet once and then do it again in 10 years, or we just do hardwood flooring throughout the whole house. So we decided to do it. We're doing it. Guess what happens when you do a big project like this? It's dominoes. It's a snowball of other projects. So sure, we're getting new hardwood floors, but then, well, someone needs to come and paint the trim because they have to put the little floorboards on for the trim, right? Someone's got to caulk it and paint it because the flooring company won't do that. So we got to get a painter in, and the painter's coming to paint the trim, so they might as well do the walls too because we got to have a new color for the walls because it's got to match the floors.
Well,
and then,
while you have the floor up, you should do some added insulation, right? Make things more efficient.
Heated floors in the bathroom would be nice, actually. No, but then it's, wait a minute, this flooring does not match the railings and the newel post leading up the stairs. And the painter says, shoot, that the material and the finish there, we can't paint this. We'd sand it down 12 times and it still wouldn't look right. Just get someone else to fix it for you and put a new one in. So now we're not only getting new hardwood floors, we're painting the whole house, and we're getting a whole new banister set. Just put it on my tab.
And now, do you have to move out at any point, or are they doing it like by room?
I think probably we're going to do it in pieces, but probably for the first week when they rip everything up and they have a big dumpster in our front lawn, we're going to get away for a week later in the summer. So
because that's going to be wild.
The thing is, once you go down the road of we're doing a big project, it's kind of like this is going to cost a little bit more. Sure, do that too. Put that on there too. And so just whatever you're doing a project like this, just add 20 to 30%.
Well, it's also kind of like on tires, how they talk about upselling once you're already spending a lot. Once you're already spending a lot, I mean, what's another 1,000 here,
And I know once we get our furniture back in the house, my wife's going to go, oh, we need a new dining room table now too. And that couch, that doesn't go anymore. So I'm mentally bucketing for this.
We need a furniture sponsor. Let's get a furniture sponsor.
Seriously. Yes. So I'll be using my home equity line of credit very religiously in the next few months. Thanks to everyone in the live chat. As always, we appreciate it. Email us, askthecompoundshow@gmail.com, or follow us live on YouTube or Twitter. Ask us a question. We appreciate all your questions. Thanks everyone for showing today. Much appreciated. Everyone enjoy the 4th. After this, guess what? I'm heading on the water. I got an Oberon with my name on it.
Okay, I was about to ask you your drink of the day. This is Oberon.
Oberon with an orange. That's in the sun. Can't beat it. See y'all next week.
Happy 4th. See you, everyone.